wait.
I just
Oh,
started it. I can cut it out
yeah, we'll
afterwards.
we'll wait maybe 2 more minutes or so, I guess. You just give the go, Alex. It's since you're handling most of it.
All right. Well, thank you guys for showing up. Basically, your last class for the semester. I appreciate you guys coming. So I just basically want to just review some key concepts. It shouldn't like be a lecture at all, but just like some concepts about fiscal and monetary policy that it kind of makes sense. So in essence, was what chapter 21 is doing. It's showing the tools that government and the Federal Reserve Bank have at their disposal to increase aggregate demand. So basically, think of it like this. Back during the Great Depression, they did not have these tools. The Federal Reserve Bank did not really know anything about these tools, and the government also. Um, and basically, that's why the Great Depression was so bad. And this is actually from the Keynesian economics school. So every time you hear Keynesian economics or Keynes, that's from his school of thought, kind of, where they argue that if you increase government spending or increase the money supply or do tax cuts, then you will basically increase aggregate demand, which will in return increase GDP. So you can kind of see this happening right now. For example, think about maybe it's a bit different, but the stimulus check, you know, pumping money into the economy, totally increasing the money supply. That's obviously rare, but that would be the same intuition behind it. So you're just trying to increase aggregate demand. So basically, by doing that, it causes the three effects. It causes the wealth effect, which refers to price level. You feel richer. Then there's also the interest rate effect and the exchange rate effect. So basically, through these tools above, one of these three effects take place, which in return decreases or decreases the aggregate demand. So that's why it's also important that you understand the previous chapter pretty much to understand this chapter, because they definitely build on each other. And if any of you guys will take just like that, nothing to do with the exam, but if you guys take an intermediate macro class, you'll probably hear about the ISLM model, which basically, in my opinion, it's almost easier than the principal one, but it refers to the same concepts. So here I basically summarized it a little bit. The government and central bank, they have tools that set off one of these, which ultimately increases or decreases aggregate demand. And in this chapter, you're just basically going to this one graph and showing the changes in interest rates and those kinds of things. So the graph looks like this. So basically changes in money supply, changes in interest rate, like I said, is referred to as monetary policy. And then changes in government spending and changes in taxes is fiscal policy. So before I want to go into the practice questions, there's one more funny thing. So it doesn't matter where you're on the political spectrum. So for example, 2001, Bush, he did tax cuts. These tax cuts increased aggregate demand, which increased the economy. So basically, it was expansionary fiscal policy, which in normal words is basically just increasing aggregate demand. Let's get it going. When there was the Great Recession, 2008-9, or Obama, I think he didn't do tax cuts, but he increased government spending by a lot. He used the same intuition, and then Trump came into office and he did again tax cuts. So like the last three administrations have been, definitely pumping up that money supply, which you're like, what's the downturn? You guys aren't covering that, but all of the administrations increased the debt by a lot. So it comes at a cost, but that's not in you guys' class, just in case you were wondering. So the chapter 21 practice questions, you basically, you maybe already saw these. So number one is when the interest rate increases the opportunity cost of money. So the answer is B, but why is it B? So when the interest rates are high, people leave their money in the bank. kind of the older chapter with the, I think, markets for loanable funds. I think I covered that kind of, that if you could leave your money in the bank and you got like 15%, like people would basically not really demand money. They would probably just leave it there. So that's why the answer is here B. A lot of these questions, you should kind of think simple terms. Did you do number 2, Justin? I think Justin did number 2.
Yeah, so I did do number 2. Just something to mention as well first, just real quick, is Alex and I were talking about going over the homework as well briefly, but I think, given a lot of the feedback from the class, it just may be more beneficial for us to just go over all of these practice problems, since these are the ones that you'll see on the exam. So we're going to be flipping back and forth. So I'm going to go over number 2 here real quick. So I'll share my screen right here. And so I don't have an iPad with me, so I kind of had to do a Word document. So when we're looking at this graph, you guys should be a little, pretty familiar with this. You're gonna have your interest rate on your y-axis, and then you're gonna have your quantity of money on your x-axis. And the book talks a little bit about why the money demand curve is sloping downward. As interest rates go down, money demand increases. And then the Federal Reserve is going to have a fixed money supply. So that's why you're going to have that straight line. So in this question, it's talking number 2, if the current interest rate is at 2%, what is the correct answer out of these? So if we go to our y-axis, see right here, we've got 4%, 3%, and 2%. And I won't spend too much time on these intuition questions, because I'll upload the handwritten solutions that give you guys a little more explanation behind some of these questions. But it says if the current interest rate is at 2%, so we're going to be here. What is the answer? So we're going to be at point D, and basically what we know by that is that's going to mean our money demand is going to be greater than our money supplied. So in some way, unless the Federal Reserve would somehow change this money supply by Federal open markets operations, any sort of their tools that's going to shift that money supply out to the right, that'll get it to this equilibrium, what's going to happen? Is there going to be an excess money of supply? Obviously not, because you're going to have a greater demand for money than supply. So obviously there's a greater demand. So there's less supply of money. As the money market moves towards equilibrium, people will buy more goods. No, the textbook kind of talks about that, and that the relationship between interest rates and people buying goods. So your best answer is obviously, it can't be D. All of the above are correct. It's going to be B. So people are going to sell more bonds because they're demanding more money, but this is obviously going to drive up the interest rate. So
also here to add,
yeah.
The supply of money is not the quantity of money.
Right. Yeah.
If you're over reading, you might be like, oh, the supply quantity kind of maybe the same. It's definitely not the same. So don't make that that's a mistake that happens quite frequently.
Mm-hmm. All right. Yeah. You can go on to number 3 and 4 then. Here, Alex.
Let me share again.
Yeah. And maybe you can hit 6 as well, and I'll just hit 5 and 7. Yeah.
What I also wanted to say, so basically the only shifts in the graph, I can kind of make this here. It's basically if the Fed does monetary policy here, look, the money supply shifts, that's where the equilibrium interest rate kind of shifts. But then also if the demand, then this is how you see the interest rate gets affected by these kind of shifts. That's basically the whole chapter. But obviously a bit more. Well, number 3, which of the following statements is correct for the long run? Well, with those kinds of questions, also in general, you have to take them step by step. So the first thing is output is determined by the amount of capital, labor, and technology. The second one, output amount of capital and technology. So this is obviously true, because like you can say output is like GDP, and we talked about that, how capital and labor affects those things. So output response to aggregate demand for goods and services, no. So basically you can already cross out D for that matter. And then you go to the second one, the interest rate adjusts to balance the supply and demand for money. The interest rate adjusts supply and demand for loanable funds, and interest rate adjusts supply and demand for loanable funds. So here you read these three. Obviously, you just need to know that it's B or C, and the last one basically gives the answer. Then you have these B and C left, and you have to say the price level adjusts to balance the supply and demand for money. And also it's good for you guys because it's basically open note. So if you're familiar with some of the concepts, you don't need to like 100% memorize, but you need to at least know where you wrote it down, if that makes sense. Number 4, fiscal policy refers to the idea that aggregate demand is affected by changes in government spending and taxes. Number 4, I basically talked about that a lot in the top section, that basically government actions, fiscal policy, Federal Reserve Bank monetary policy, not trade policy and the money supply. The government can't affect the money supply. Probably that's a good thing. I didn't, wait, you did number 5, correct? Yeah, you're muted. Yeah, I'm gonna give it to you.
Just do number 6 and I'll get to 5 and
oh later, yeah. I hope you guys like my little drawing. No. So number 6 is to reduce the effects of crowding out caused by increase in government expenditures. The Federal Reserve Bank could. So basically, increase the money supply by buying bonds. So here I drew a little graphic to show how actually the buying and selling bonds increases or decreases money supply, because then it might make more sense. So the Fed is here. Well, this little thing should be the Federal Reserve Bank. So if they sell bond, they buy bond with. Yeah, so the Fed, they buy bonds from investors, but then the investors, the money travels basically from here to here, which is the money supply. Basically, imagine all the investors have the money supply and they get the bond. So the money goes from the Fed into the investors' hands, and this all is the money supply. So that's why it increases if they buy bonds. They're basically giving the money to the money supply. So it's basically reverse psychology to how if you buy something at Walmart, you're increasing Walmart's money supply, right? So in this case, they're just buying the bonds from investors, so they're increasing the investors' money supply or the overall money supply. You need to just wrap your head around it a little, but I remember when I was an undergrad, we had like something like this, and that made me understand why when you buy bonds, you increase the money supply if the Federal Reserve buy bonds, and the opposite happens if they sell bonds. The money goes from the investors to the Federal Reserve Bank. Should I just quick do number 9? I can do number 9, and you can do numbers 5, 7, and 8, because Justin kind of did the math part this time. So number 9, as real GDP falls, you have money demand rises, so the interest rate rises. Money demand, interest rate falls. Money demand falls, so the interest rate rises, or money demand falls, so the interest rate falls. Also, with those kinds of multiple choice questions, you can already kind of eliminate a lot of choices without even thinking of the intuition, just by thinking of it logically, that like if money demand falls, the interest rate couldn't rise. However, but here I kind of wrote this graphic. So why does money demand fall when GDP falls? Again, think recession, think right now, think Great Depression. Do people really want like all that money if the economy is in a recession? No, you're usually like saving. You're not really taking out these huge loans and stuff. So yeah, that's why the money demand falls. And if it falls, you see this shift causing the interest rate to go from interest rate 1 to interest rate 2. And remember, only the Fed can this is fixed. This is going to stay there unless the Fed touches the money supply. So yeah, so that's why you see this shift. All right.
All right. Yeah, so I'll go on now to some of these other questions. So I think I'm starting off with 5, and these are a little bit more of the analytical questions. So I'm going to just start running through these, and if you guys have any questions about anything, uh, always feel free to stop me. So we get this question. It says that in a certain economy, when income is $1,000, consumer spending is 800, right? And the value of the multiplier for this economy is 2.5. It follows that when income is what is consumer spending going to be? So I think the first way to kind of solve this problem out, and so I'm going to go into the equation editor here on Word, and I'm just going to kind of start doing this equation. Remember, we talked about this money multiplier being equal to, and I think I've got it in the LaTeX one, this sort of equation right here, which is 1 divided by 1 minus our marginal propensity to consume. Now, another way of kind of expressing that is, think about that. If you're a consumer and you have money, you either have 2 options. You can either save your money, or you can decide to spend your money or consume your money. So realistically, if I'm taking, all of my income, some of it is being consumed, but then that means that the other percentage has to be spent. So that's the other idea, is the money multiplier is equal to 1 over the marginal propensity to save. So if we knew that the value of the multiplier for this economy was 2.5, then we can say that 2.5, let me go back to the equation editor, 2.5 is going to be equal to 1 divided by what? So I'll just label that as X. And then when we solve that out, we're going to get that the marginal propensity to save is going to be equal to 0.4. Now, in other hands, recall we knew that the marginal propensity to save, as I said earlier, is equal to 1 minus the marginal propensity to consume. So if we know that that's going to be our marginal propensity to save, then we know 0.4 is going to be equal to 1 minus X. And in that case, X is going to be equal to 0.6. So we've just solved our marginal propensity to consume. Now, for the second portion of this question that you kind of need to have in mind, what is the marginal propensity to consume? So as I kind of talked about in the textbook, and I know I won't give too much of a definition just on time, the marginal propensity to consume is simply going to be, sorry about that, your change, and I'll use delta for this one, your change in consumer spending divided by your, and I'll use delta again there, because delta denotes change in mathematics, your change in income. Sorry about that. Yeah, it's a little messed up. Anyway, I'll just cut that out. So MPC is equal to change in consumer spending divided by change in income. So having that taken into consideration, when we went from $1,000 to $1,020, and that means our income changed by $20. So MPC is equal to X divided by a change in $20. So if we knew that our marginal propensity to consume now is 0.6, then what is X going to be equal to? So if we multiply 0.6 times 20, we're going to get that X is equal to 12. And what is this basically saying? This is basically saying that a $20 increase in income leads to a $12 increase in spending, right? So $20 of this new income that you get, $12 of that is going to be spent, or 60% of that is going to be spent. So we know that in a certain economy, when income is 1,000 and consumer spending is 800, it follows that when income is going to increase by $20, which we talked about, a change in income of $20, then our change in consumer spending is going to be $12. So that means that we're going to have $812 for a change in consumer spending. So we know that that's not our change in consumer spending, that's going to be our consumer spending. Now, for the second portion, so we've eliminated A and B. For this economy, an initial increase of $100 in consumer spending translates into a $250 increase in aggregate demand or an $800 increase. And basically, the way you figure out that one is you take that consumer spending and you're going to multiply that by the money multiplier. So if we know that $100 in consumer, we have $100 of an increase in consumer spending, and 100 times 2.5 is going to be 250. So in this case right here, C is going to be our answer.
And then again, if you didn't know the first part and you had to just eliminate choices, could have just done the 100 times 2.5 and already eliminated B and D.
Exactly.
And then you have a half percentage point. Like we're just there to help you guys get better grades. So at this point, so just this for this chapter, especially those multiple choice ones, be smart. Like when you guys took the SAT, for example, especially in this chapter.
Yeah. And also another thing I can say about the money multiplier, kind of from an intuitive perspective, is the way that I always like to think about it is, say you have kind of like a pebble, this is kind of the classic way they explain it in economics textbooks, and you throw that pebble into a lake, it has a sort of ripple effect. And, Mankiw talks in his textbook a little bit about the math about how, say government and spending increases by that much, then now these people are going to get income that they didn't originally have. And then when they spend their money, the people like, it kind of goes down the line, or basically like I receive $100, I give that 100, I spend $80. So now Alex has 80 new dollars if I buy a good from him. And now Alex is going to take, maybe $60 from that, and he's going to buy some good or service from Corey. And then it's going to just keep going on and on and on. So that's kind of the idea behind the money multiplier. So I did 5. These ones are going to be really simple. The marginal propensity to consume for this economy is what? And basically for this one, we're going to use that same equation. It's going to be change in consumer spending divided by change in income. So as we can see right here, we have a change in income of 500. And then I'll just go into a calculator real quick. If anybody already had that calculated out, 740 minus 6720, that's going to be 320 divided by 500. So if we do that out, it's going to be 0.64. So that's going to be our marginal propensity to consume. And now the money multiplier, and like I was saying, this is going to be just the equation you're going to need to know, 1 divided by 1 minus MPC, or another way of, like I said, of expressing that is just 1 divided by marginal propensity to save. But since we know the marginal propensity to consume, we can do this as 1 divided by 1 minus 0.64. And when we do that out, 1 minus 0.64 is going to get us 0.36. So 1 divided by 0.36 gets us 2.7 repeated, or roughly 2.78. And so in that case, 8C is going to be our answer. And since Alex, I think you went over 9, I'll just quickly go over number 10, talking about this idea of crowding out. So what is crowding out? And basically the way that you can think about it is, and actually it may be better for you to just pull that up on your screen now, Alex, because my Microsoft Word document was a little weird on that, just copying that over.
Yeah, hold on 1 second.
The idea, you can think of crowding out, and you can think of it kind of, I know in a sports economics class that I had, we talked about this a little bit. And basically, say you have like a big sports event, sometimes that sports event might crowd out some of the other business in the area. So say when they have the Boston Marathon in Boston, they have to close down a lot of those streets. And so sometimes those businesses that were originally going to be open are being crowded out by the big sports event. So you can apply that same concept to the government purchases. So when you think about it, when you have an increase of government purchases, so when we're thinking about this, let's just not even consider government purchases going down, because we're thinking about the government crowding out other investment. So when we have government purchases, it's going to obviously increase GDP, from that equation that you guys learned, the Y is equal to C plus I plus G plus net exports. And so when you have an increase in GDP, people are obviously going to want to buy more goods and services. That's going to increase the demand for money. But now when this demand for money increases, which I think Alex is going to have a graph showing that, the money demand curve is going to shift up. And when that money demand curve shifts up and you don't have any change in your money supply, your interest rate is going to increase. So now we're going to have a higher interest rate. And now it's going to be more expensive for people to borrow or businesses to borrow. So businesses aren't going to invest as much. And that's going to cause the quantity of goods and services demanded to go down. So your correct answer is going to be C, just
Yeah.
solely based on intuition. But so that's kind of what you need to be thinking about with the crowding out effect, is that government purchases are crowding out the private sector of investment. So that is 10
Well,
and
you could also, and especially like looking at this question, you could already answer that even without knowing crowding out. I'm just giving an example. Government purchases increases GDP, supply of money. That's not true. So you could already eliminate A. And then looking here, government purchases goes down, decreases. Well, I guess the only thing this is correct. So the B, so you could have eliminated A and D. That's what I'm saying. Taxes increase, GDP, demand for money, and that one too. But yeah, he said it correct.
yeah. Yeah.
I can go further. The multiplier for changes in government spending. Justin already kind of showed you that formula. That it's basically 11 is D. This should be a free point for you guys if you have this kinds of questions. Keynes uses the term animal spirits. Honestly, I doubt you would ask this question. But again, like I said earlier, Keynes is kind of the father of this idea with fiscal and monetary policies to stimulate the economy. And yeah, I guess this is the arbitrary changes in attitudes of households and firms. Really can't go too deep into that one. Here, the next one, number 13, suppose the businesses and consumers become much more optimistic about the future of the economy. To stabilize output, the Federal Reserve could, and they want to raise interest rate by selling bonds. So here I did the same graphic the other way around. What happens is the Fed, they sell bonds. So the investors get bonds, but they lose the money by buying these bonds. So that decreases the money supply. So basically, when you decrease the money supply, you see the shift from this initial level to the left, which triggers the interest rate to rise. This is the only way. And why do we know that they would want to lower the interest rate? Because it's basically optimistic about the future. Think of it like that. Think of like depression, recession with increasing money supply. But if things are going really well, you don't want to necessarily like overdoing it. That has other causes too, inflation, etc. But basically, they want to stabilize it. They don't want it to go quote unquote almost too well, because it has other consequences. Number 14, the price of imported oil rises. The government wanted to stabilize output. Which of the following could it do? Increase government expenditure to increase the money supply. I talked about it. Expansionary fiscal policy. Increasing government spending means kind of getting the economy going.
Yeah, and to bounce off that a little bit, Alex. So for number 14, so if the price of imported oil rises, then that obviously going to hurt a lot of businesses. It's going to make their factor costs increase. Say if you have machines that require oil, so that's obviously going to hurt a lot of the economy. Now, what can the government do? Go back to that original equation that I was talking to you about, the consumption plus investment plus government plus net exports. If the government increases expenditures, that's like Alex was talking about, that expansionary policy, they're increasing aggregate demand. Or at the same time, what can they do? They can increase the money supply. And if we look back at that graph that had the money demand and the money supply on the vertical axis, if the money supply shifts to the right, that's going to cause the interest rates to go down.
Yeah, it's
Interest
basically
rates go
like
down, it's going to cause
the other way.
increased investment. So that's another way to think about it. So yeah, a big thing is just for this chapter, Keynes just talks a lot about using government policy to kind of increase aggregate demand. So a lot of these questions, they're going to be geared towards you know simply just what policy would be the most effective to increase aggregate demand. So fair enough.
Yeah, so now figure 2, the aggregate demand curve could shift from um, decrease in net export. With those ones I didn't really. Did you do any of those, like the explanation?
Yeah, I did the explanation for number 17.
17.
Yeah.
Wouldn't the figure that you just showed, wouldn't that be a determinant of why it would shift it, or no?
Yeah, definitely. Then that's the net export. What I talked above.
Mm-hmm.
Here, wait, let me say. The net exports, I think, triggers this exchange rate effect, and I think I didn't write anything down because you just kind of need to know that the aggregate demand curve should flip as a result of an increase in government purchases would basically increase the aggregate demand curve. So that's why I could eliminate A. Households saving a small fraction of their income would not have an effect on the aggregate demand, and a decrease of the price level would, I believe, also, I think also push it to the right. Or
Yeah, well, so Corey, I think because I think we kind of explained it a little bit poorly last week, but that's going back to like those ideas of the wealth interest effect and exchange rate effect, or like why does the aggregate demand curve slope downward? So if you have like a decrease in the price level, you're obviously going to feel a little more wealthier. The money that you have on hand is going to be a lot more valuable. So say, instead of going to the grocery store and it costs you maybe $2 for a loaf of bread, and then the price level decreases to $1. Now, instead of just buying one loaf of bread, with that same money that you have on hand, you can now buy 2 loaves of bread. So when you have that decrease in the price level, that's going to want you to, buy more goods and services, or you're able to buy more goods and services at your disposal because you feel more wealthier off. And yeah, I think you explained it very well, Alex, with the decrease in net exports. You can kind of look at that from the exchange rate effect where, you have the lower prices that lowers interest rates. So investors are going to want to, move to overseas investments to try to get higher returns. When all of this money from the domestic market goes overseas, it causes the real value of domestic currency to fall. So, since there's more money overseas, like more.
Yeah, that's the thing that I kind of was a bit rusty on. Yeah, the net export effect, that's why I kind of didn't go over it, is definitely very hard to grasp with the overseas and exchange rate and everything. So basically just like kind of memorize it. I doubt that she will ask why it is. It has to do with the overseas, the investor, the price level, but now you have so many things involved. So that just like basically knowing about the exchange rate effect and how net exports trigger them is good, and just knowing the shifts. And I think that should be fine.
Yeah.
But if you're an econ major or you're interested in economics, look this up. Know what Justin's talking about, but I doubt she's going to go so into detail of like why.
So if the price level were to drop, would that shift? What curve would that shift in?
The aggregate demand.
Okay.
Because so this is from chapter 20. So remember here was the price level.
Right.
Price level. And here was I think the GDP or output, Y, whatever you want to call it. So if the price level is the price level of the economy, we have a pretty high one, but like low income countries have a pretty low one. So that's why when you travel overseas, let's say to a developing country, the dollar gives you so much, like, because people can live it like kings overseas with the same money. So if the price level decreases, aggregate demand will actually increase.
Well, yeah, and what I would say, Corey, is like, because that graph, like I think that Alex is trying to, or that Alex is referring to, is I think it's the price level and nominal money stock. So the nominal money stock is on the x-axis, and now so
Oh,
when basically when the price level rises, like if you want to think of it from a very intuitive perspective, when the price level rises, you need a lot more money, to buy the goods and services that you had before, right? So say instead of $2 for a loaf of bread, now it costs $4. So, you need more money on hand to be able to buy those goods and services. Now, if the price level falls, and this is what the wealth effect kind of talks about, is say you have like the price level falling. When the price level falls, that means that the money that you have in hand, so say if you had $500 in hand and the average price of goods falls, you can buy more goods and services. So since you're able to buy more goods and services now, individuals feel more wealthy, they feel better off. So it's going to stimulate consumer spending because now they're going to be able to buy more goods and services than they were before. And so that's going to increase the demand for goods and services. So that's what would shift the aggregate demand curve, is from that wealth effect. And that's why the wealth effect is downward sloping. Does that make sense?
That does. That does. That's what in chapter 20 was kind of confusing to me, even in chapters 3 and 4. I felt like I would grasp it and then I wouldn't. Like I knew the determinants of like what would shift the demand curve and the supply curve and all that, but it's confusing which way it shifts sometimes, because now I get what you're saying with the price level and stuff like that and the aggregate demand. So just for example, what would shift the aggregate supply then?
Okay, so aggregate supply, that's when you're looking at that ADAS model. Here, let me pull up a good definition.
Also,
Sorry.
no, chapter 20 is definitely the hardest. And I don't know if you saw, I think she uploaded individual videos actually. Did you see those? She actually,
I don't think so.
no, on Canvas, you should look. I can show you right now. And while Justin's looking it up, she actually uploaded, like, I think she didn't really tell you guys about it in class. That's why I wanted to show you guys, everyone that's in here. I'm going to quick share my screen where you guys can find it in modules.
But just to answer your question there, Corey, so what you may remember from that aggregate supply, aggregate demand model is that, you have that short run aggregate supply that's upward sloping that you kind of talked about.
Mhm.
But in the long run, aggregate supply is just, it's not gonna, the price level isn't gonna have any effect on aggregate supply. So I think the easiest way to kind of think about what would shift aggregate supply, that's basically like increasing productivity. So no matter what the price level is, and that's where you talk about monetary neutrality, classical dichotomy. When a country is able to effectively produce more goods, then it's going to have a larger aggregate supply. So if there's some sort of increase in productivity, that's going to shift that long run aggregate supply curve to the right. Another thing that she briefly mentioned, I believe, in class is like if the government puts in some long-term policy that allows for people, to say have like a better standard of living, like say the government really increases education and, now people are more educated, they're more productive, that's going to shift it to the right. So long run government policy actions. And then also, I think the other shifter talked about was resource prices. So if resource prices decrease, kind of like how just in micro, if it costs a company less to produce a good, that's going to shift the aggregate supply curve to the right, or vice versa the other way. Does that kind of make sense?
It does. It does.
Yeah, and here I showed it in module 7. She did 4 videos actually, where she talks about those in actually detail, just because I think she kind of figured that people were having problems with aggregate demand and supply, because it is probably the hardest concept you guys are talking about. And like you said, the the micro is way easier to grasp, kind of, than the macro aggregate demand, because if you came last week, I talked about how actually aggregate demand and supply is more of an idea than an actual thing. And to all these things that we're telling you with the shifts, they're not like 100%. They're not like a law, if that makes sense. It's more like a conceptual idea.
Yeah, I get what you're saying. Okay.
So wait, let me share again my iPad. Let's quick finish. We're already over time. We didn't want to waste so much of y'all's time, but we're almost done.
So I think we're on 16 now. Yeah.
To figure 2. This is again, if the economy is at point B, a policy to restore full employment would be increase in the money supply, decrease in government purchases, an increase in taxes, or all of the above. Basically, think about it like this: increase in the money supply, expansionary policy. Just think of increased money supply, basically trying to get out of this recession. Aggregate demand will make the people spend more, and you'll go back to full employment. A decrease in government purchases would not be expansionary, it would be actually contractionary, which means it would go kind of down. Increase in taxes too. And also a good way of looking at it, everything that adds to the debt is quote unquote gonna increase aggregate demand, which is the problem with all of these things. So if you really don't know, like increase in taxes would basically help the debt, but that would be bad for aggregate demand. Decreased tax cuts, bad for the budget, good for the aggregate demand. Increase in money supply, bad for the debt, good for aggregate demand and employment and all of those things. If you just need a little hint. And hence why our debt is growing so much, especially after Corona. This chapter basically explains it somewhat.
Yeah, and yeah, so I'll do number 17 here. Yeah, but also another thing to add on that, what would an increase in the money supply do? Go back to that same graph again. If money demanded is still the same, an increase in money supply, that's obviously going to shift that curve to the right. It's going to drive the interest rates down. With a lower interest rates, business are going to want to invest more money. So invest more. Just think about it in investing more. When they invest more, that's going to increase aggregate demand, as we talked about. So right here, that figure that you're looking at, that's called a recessionary gap. Now, if you go down into number 17, the question, it says, which of the following is correct? And I think, there's a couple on there where it says unemployment rises as the economy moves from A to B. I mean, of course it does. If aggregate demand increases, then there's not as many people buying goods and services. So firms' profits obviously drop. People are going to have to be laid off. A is definitely correct. Either fiscal or monetary policy could be used to move the economy from point B to point A. That's correct. The government could either increase government purchases and decrease taxes at the same time. That would allow people to spend more money, increase aggregate demand. Or they can do what I just talked about with monetary policy, increasing the money supply. And so we obviously know that all of the above answers are correct if A and B are correct, but also for some intuition on C, if the economy is left alone, then as the economy moves from point B to the long run equilibrium, the price will fall further. And that's kind of the argument against some of these policies. So, there's kind of a big divide between Keynesian policies and a lot of, they call them neoclassical or
monetarism. If you guys know Milton Friedman.
Yeah, and like if you go very even further that way, there's a school of thought called the Austrian School of Economics, and they're very heavily against any sort of changes to aggregate demand. And what their kind of argument is by changing aggregate demand in the long run. So from going to point A to B, it's not doing anything for us, but just increasing the price level. Whereas if we just did not increase aggregate demand at all, we would be going from that point B all the way back down to the long run aggregate supply. So the price level would drop and we would still be at the same point. So basically, we're just increasing the price level without doing anything. So that's kind of that other side of thought on
Yeah,
that,
you
where
can
Kane
think of it
says,
almost like the libertarian side, like kind of like leave it alone, the invisible hand, in that sort of sense. And obviously, the pros of this this school of thought is it doesn't add to the budget, to the government debt. Yeah, which
I
I
guess you
feel like
just
we
want
really
to
talked
close
about.
out then, Alex, with the last three.
Yeah, which of the following is not an automatic stabilizer? I think that's one of those just like kind of memorization problems and not really concept. The minimum wage is not a stabilizer. To be honest, I don't know much. Did she cover really that or in the book? Um, but yeah, the Fed conducts open market sales. The money supply decreases and aggregate demand shifts left. I think this open market sales is basically um, either selling or buying bonds or the interest rates, and then here shifts left. And if the stock market crashes, then aggregate demand decreases, which the Fed could offset by increasing the money supply. So like the whole time we were talking about increasing money supply, if something goes left, you increase the money supply and then everything's perfect again. Yeah, that's basically it.
Yeah, so that was just about everything. So I think just a couple things actually I did want to add on it as well is I know you guys really like those handwritten out solutions. So I'm definitely going to try to work on those over the weekend. And I'll be talking with Alex a little bit about that. Another thing I'm definitely trying to do is